Welcome in, grab a seat. Let's go ahead and get started with our general meeting. Welcome to the Investment Society, everybody. Okay, so our general meeting agenda here, we're gonna start with the quotes, some outperforming moments, and we're gonna have another and last final internship spotlight here with our treasurer, Jason. And then we'll end with some society updates, so definitely stick around for that because there's important news. So this week's quote is pretty long. I got it from Instagram, but I really liked it. Not being busy is a competitive advantage. Most people are so strapped for time, they can't take advantage of lucky opportunities or quickly resolve unexpected problems. The ideal combination is proactive and flexible. Protect your free time, but maintain a bias toward action. I think this really struck to me because I really do love my free time, right? But I need to stay proactive continuously. So it's by James Clear. I quoted that one. Really like that quote. And now for some outperforming moments. Let's get 3, like always. I know people have been getting job offers. Yes.
I went to a trivia last night, trivia night. I got a 4th place out of like 20 teams.
Nice. Okay. Yes.
Yes, the internship was extended to the spring.
Congratulations. Great. Extension. Anybody else? One more. There's a lot of people on the right. Okay. Who's the one who got a job offer that they posted on Discord? Can't recall the name. All right, let's continue. Let's continue with the internship spotlight with Jason. Round of applause.
Hi, everyone. Hope you guys are doing well tonight. Thanks for coming out. So my name is Jason Burkhart. I am the treasurer for the Investment Society. And I had the opportunity to talk about what I did for my internship. So I worked at Fortress and it was more conceptual. So I'm going to be going through that. I worked on the corporate lending team. I'm going to be talking briefly about the project and any tips and resources. And if I don't bore you guys enough, I have a bonus part at the end. So Fortress, they are a leading, highly diversified global investment manager founded in 1998 by 3 gentlemen, Pete Bridger, Wesley Edens, and Randall Cardone. Pete Bridger and Randall, they started a credit fund. Wesley Edens started the private equity fund. He predicted work from home 4 years earlier, and I sat across from his office. This is kind of after he made his best investment when he's made an investment to the Milwaukee Bucks, and he owns that team. So that paid off as they won the championship not too long ago. But as I mentioned, that my internship is more conceptual than anything. So what is a hedge fund? Fortress is a hedge fund. By definition, a hedge fund is a complex pool of investments that trade relatively liquid assets by using different investment techniques. But at Fortress, what we did was we raised capital for private equity firms in our hybrid hedge fund model. So at Fortress, what we called for our hedge fund was the drawbridge fund. So this was unique because it had liquid and illiquid assets. So like generally a hedge fund only has liquid assets, so investors could redeem whenever they want. But with this one, investors can redeem once a year, so it sells like a private equity fund. As I mentioned, I work for intern for the corporate lending part. So when you're lending out money, you're originating loans. So it's a captive business. So it's a fee-based business. So there's a 2 and 20 fee structure. 2 comes from originating the loans. The 20 is tied to the percent of carry. So what I mean by the carry is the profit made on that investment. Now, generally at Fortress, we like to stay at the top of the capital stack. So being first lien and senior. So just ensuring that we're being the first ones to get our money back. Going on how we generated a lot of our income. So I like to look at the model, and I realized that a lot of these investments we were making had 15 to 20% unlevered IRRs. The way that we did that was through broadly syndicated loans. Now, broadly syndicated loans, we took CLOs, which are collateralized loan obligations. They're made of about 68% of the broadly syndicated loan market. And what CLOs are, they're just pools of debt, and you break those up into tranches, and that's what the VSL would be. And we usually give these out to financial distressed companies or companies that, you know, are about to go bankrupt and need restructuring. And usually what these companies would do is they would send these out to other institutional investors, and, you know, they'll buy that as well. But going on, I learned a lot more about different lines of businesses. So talked to some of the real estate team, and the difference between real estate lending and corporate lending is real estate lending, you're lending more based on the asset rather than the intrinsic value of the firm. So not your EV to EBITDA, not your PDE. It's solely just based on the asset. Also learned about litigation, which was very interesting. And Anna and Carlos talked about this when they were talking about their Internship Spotlight. It's basically representing and suing arbitration clauses, very similar to how Elon and their little Twitter scandal was going on. But going forward, since I did work on the corporate and debt securities, so corporate lending team, there's a range of activities that we do. So we perform bank debt bonds for levered vehicles. So CLOs and CBOs, I listed under here. CLOs are collateralized loan obligations, pools of debt. Collateralized bond obligations are corporate bonds. And also we looked at public investments as well. So you the preferred and common stock, and also distressed debt. And so for the goals of the business, what I mean by the performing debt is usually in the financial services, you're going to be doing business with people simultaneously, and performing debt is the ones who usually pay down, you know, the principal and everything. And so the whole goal for that is don't lose money. Now, for a special situation is when we're looking at more distress opportunities, and our goal is to buy low and sell high. So example of that is paying 80 cents on the dollar in order to get into that investment. And once they recapitalize, restructure, and everything, we will sell it. So going forward, I worked on a project, and we were sourcing a loan for this. Or yeah, we were sourcing a loan for this private equity company to a home appliance company, and it was a pretty big loan. I'd say not really, kind of, sort of, but I have characteristics of the loan. I don't want you guys to pay too much attention to that, but we believe that the term loan was very appealing due to the fundamental risk and also the 10.5% unlevered yield to maturity. So was this a good deal? Well, let's find out what my team and I did. So I know this is blurry, you can barely see, but we have our sources and uses on here, our exec summary, our proposed terms, and so forth. Also, we have our projected summary of cash flows, our historical financials, what the company does. Also listing out the risk and mitigant section, and ensuring, I just want to let you guys know, really listen to Professor Sweet when he says, learn Bloomberg, because when I was comping a private company to a public one, it's hard to YouTube that. So use Bloomberg as much as possible when you're doing stuff like this. Listed the management team as well. So any takers, do you think we did well on this project?
Yeah.
That's what my MD had to say. He's been in the business for quite a while. You can definitely tell that working for a hedge fund or anything, you got to have attention to detail. He definitely tore us apart in this. And, you know, I was like, okay, you know, it may get better going forward, but that was definitely not the case. He just kept grilling us. You know, we had a few good comments in there, but more about it, what we can do better. And, you know, that's the whole sole purpose of an internship, right? But he did end up giving us an A- and a B+, which I think he was just having a really great day. The reason why I say this is he ended up going to his beach house halfway through the internship. And, you know, it just had to be a good day for him. It was the end of the internship. That's why we got it. But kudos to our team. Going forward, as I mentioned, I want to give you guys some tips on recruiting and some resources. So internship guidance first. If you guys are a freshman, sophomore, or junior, SEO is a really good nonprofit organization that can help you get internships. Myself, my colleagues, and Anna have utilized this platform. So really utilize it, you'll get put in front of a lot of big companies now. For MLT, if you're looking to get into software engineering or consulting focus, and you're a sophomore, scan that QR code and I'll help you with the whole application process. Now to go talking about the recruiting stuff. So getting an internship compared to a full-time is way different. So internship tips, you got to prepare. So practicing those interviews, making sure you're running through your resume, ensuring it's like up to date, and networking. Going forward, you need to apply as much as possible because this is a numbers game. You're going to get a lot of no's. So that's why I say apply, apply, apply. And you're going to be going through interviews. So this is where you really need to tap into your network to, get the information that you need when you're going through these interviews. And then once you get the offer, I cannot stress this enough, find a mentor and a source of contact. The mentor is for when you're scared to ask the question again, you can go to that mentor and they can, explain what you just went over and, dumb it down. Finding a source of contact, that person can help you get that full-time offer, that next job. And then also fit in. If you're going into a job, yes, first impressions matter, but if you're going full suit, tie, and you see that they are business casual, it's your whole goal to fit in. You don't want to be too uptight in that environment. As well as ask questions. The more questions you ask, the better that they get. And really have attention to detail, as you can definitely see how we did on our project. You need attention to detail. Now for full-time tips, you got to network. It's way different than interview or internships because full-time, they're only hiring 1 to 2 people rather than internships. They're looking to gather a full cohort for that summer. So advice that I can give to you guys, I'm just going to run down this for the sake of time, is enjoy what you do, continue to give, be involved, share successes, take responsibility and be optimistic, do not complain, be an influencer, take and provide constructive criticism. No attitude right there, just take it. They've been in the business for a while. But if I did not bore you guys enough, I hope that this interests you. This is where I worked at. So in the middle was, I don't know what type of day that was. I feel like New York weather is way more bipolar than Texas. As you can see in the top right, that's a sunny day right there. It's my nice little work view. And then also I went to a Yankees game and I took a picture of the daytime and I guess sort of evening. And then there's some dishes on there that I wanted to show. And then also Hudson Yards to the left. And then on the bottom where you see all those people, I had spent my 4th of July in New York and the fireworks were amazing. But I'm going to conclude my presentation and I'm going to go ahead and hand it back off to the next person so they can do their job. But if you have any questions for me, please feel free to come up and ask after the meeting. Thank you, guys.
What's up, everyone? Let's talk about the markets now. So first, market recap. Recap again. Markets and midterms, meta, and then a market outlook to end everything. So first of all, as we all know, last week, the Fed announced 75 basis points again, which obviously is not ideal because it increases the cost of borrowing and decreases a lot of the productivity in the economy. So the way it works is, the way it worked last week, because yes, last week we were talking about why it was so volatile. So the way it began was that Chair Jerome Powell hinted at smaller hikes, as we were seeing that inflation was staying at 8 and not going higher than that. So he said there was going to be smaller hikes, 25 basis points instead of 75. So that's why we had a small increase. But then he said more things, right? He said it was premature to think about pausing rate hikes as there is a lot of work to be done. So that's when it started coming down. And then he also added incoming data since our last meeting suggests that the ultimate level of interest rates will be higher. So the terminal rate they were initially thinking a couple of weeks ago is now going to be higher, which again is not ideal. Okay, so last Friday we had the jobs report, 261,000 jobs were added. And this figure was stronger than we wanted it to be because obviously we want bad numbers. So it signifies inflation is coming down, but this was a strong number. So this is what this analyst said. today's numbers probably weren't the numbers the Fed wanted to see. They really need some economic softness to slow inflationary pressures, and these numbers didn't give in. Obviously, these strong numbers suggest we still have to increase interest rates, which again is not ideal. And this is kind of my own mini analysis. However, this figure is the smallest number of jobs added since December 2020, which might be good in terms of adding less jobs each month and not obviously higher. So this can't be seen as like a good metric of future of what's going to happen in the future. So then unemployment rate also came in 3.7%, higher than 3.5% in September. This is also good because if we get to a higher than 4%, which is not good for the economy, is good in terms of inflation. So the fact that unemployment rate is going higher means that we probably have less productivity. So let's talk about the markets and midterms. So a couple analysts were saying that a divided government kind of makes the sitting president legislation and the things he wants to do not go through. So it's easier to see what's going to happen. So that being said, like it says there, limits uncertainty. So we can see that they're probably not going to spend more money on another bill or another inflation act that produces more money. So that's good for that reason. And this is what this analyst had to say. It tends to make the electoral body much less effective in terms of implementing big changes, and it tends to force the policy agenda more towards the center. And another interesting statistic is that a year after the midterm tends to be the highest equity returns of a president's first 4 years in office. And this is a great statistic. According to Bespoke Investment Group, 1 year after the 19 midterm elections since World War II, the S&P 500 has averaged a gain of 14.4%. Another analyst said it's no exaggeration to say that midterm elections are one of the best historic buy signals for equities we've had. So it's basically saying every time there's midterm, the markets are going to grow from that point onwards. And this is kind of all the 19 midterms we've had and the amount of the S&P has grown after November 11th, 5. So if you want to buy, that might be a time to buy. But then if you continue reading the article, a lot of other people were saying that in this case, the inflation number is way more important than midterms. So if the inflation number keeps increasing and stays there, this isn't going to be that effective. But it has been for the last 18 times. So now Meta earnings. So they missed on earnings, 164 instead of 185, but they beat on revenue. It's kind of interesting, and I'll keep talking about Meta. But first, obviously Meta hit $96 a share. This is the price it was in 2016. So in the last 5 years, it's down 45%, and it is down 71.5 year to date. And obviously, this is a chart of all time. They IPO'd in 2012, and this is kind of the price they're at now. And all because he wanted to do AR and VR. Let's keep talking about it. So there's two ways they report earnings. There's two revenue streams. The first one is family apps, which basically is Facebook, the advertising they do there, Instagram, the advertising, the subscriptions they can do also on Instagram and WhatsApp. And then they have Reality Labs, which is the augmented reality. So first, Reality Labs, the subsidiary of Meta, which produces augmented reality and virtual reality software and hardware. Since 2019, they've invested $36 billion in that division. And obviously there's a picture there. And over the same period, the division has a cumulative operating loss of $30.7 billion. Now, even though AR and the augmented reality portion of Facebook is doing really bad, the other part of Facebook, the advertising, is doing really good. So family daily active people increased 4% year over year. So that basically means throughout all their different apps, Facebook, WhatsApp, this is the amount of people that go in every day. Facebook daily active users also increased to 1.98 billion. And then family monthly active people, which is basically the amount of people that used all their apps, is 3.71 billion, increased also 4% year over year. And again, we've talked about currency risk a lot, and this is no exception. Revenue was 27.71 billion, a decrease of 4% year over year. But if you take out the currency headwinds they've had, they would have increased 2%. And I took the number out, but with the headwinds, they would have increased their revenues by almost 2 billion, so almost 29 billion. So now let's talk about their financials. So as we can see, since 2019, their advertising has increased a lot. So they're doing really good on their other portion. But when you start seeing Reality Labs, which if you look at the numbers, they're also increasing almost 100% every year. But then the operating loss they're having is also increasing a lot. And I'll talk about the outlook in a few slides, but they're also expecting to even increase the loss they're having. So that's not ideal, right? Now let's talk about this year. So first, here we see the amount of money they made from augmented reality in 2021. They've made more money this year, but then on Q3, they made less money. And that's bad because they're increasing the amount of money they're spending on augmented reality, but it's kind of not working and they keep losing money. So they lost 3 billion. They're negative 3 billion. So their costs are obviously higher than the amount of that they're selling. Then 2.8 billion. And now this quarter was even worse with 3.6 billion. And this is kind of interesting too, because we've talked about Google, and Google lost a lot of money in advertisers because they were saying that a potential recession had a lot of the people that buy advertising went away, but Facebook has been really strong with it. Obviously 27 billion, 28 and 26, which are really strong numbers, but obviously Reality Labs is not doing really good. And this is a CFO of Meta. He said, we do anticipate that Reality Labs operating losses in 2023 will grow significantly year over year. So they're expecting the operating losses to be even higher in 2023 than what they've been in the last 2 years, which obviously market the outlook of a company is really important. And obviously that's not ideal. That's why Meta decreased 20% that day. Now let's talk about market outlook. So these are some of the analysts, what they're saying the market is going to be in the next few weeks / months. So this UBS said weak growth and earnings drag the market lower before a fall in rates helps it bottom at 3,200. In Q2 2023, it will be 3,900. So what they're basically saying is as soon as the Fed stops increasing rates or starts decreasing them, the markets are going to rebound. Chief economist Aaron Capetin, he said for the US, we now expect near zero growth in both 2023 and 2024 and a recession to start in 2023. Combined with inflation falling rapidly, the Fed would cut the federal funds rate down to 125 by early 2024. So they expect the federal funds rate to go to 125 by 2024. Obviously, right now we have 375 to 4%. Now, what is Morgan Stanley saying? If Republicans win decisive control of both the House and the Senate, the S&P 500 could hit 4,000 to 4,150 in the next 2 weeks. That's more short term. And then the last one, what really matters is the CPI report on Thursday. The only greatest force moving the markets is the inflation story. So like I said, most people think the midterms statistic is kind of being shadowed by the CPI report and inflation that we're currently going through. And that's it. And now with the chief economist, Alex.
All righty, how's it going, guys? So we got the JOLTS job openings for September. We'll go for productivity, non-farm payrolls that came in for October, and the unemployment rate, as well as talk about a little bit the diesel shortage going on. So the JOLTS, there was a jump in the job openings, right? So we had 10.7 million for September. And previous was 10.3 million. More companies are putting jobs on the market, right? So now there's 1.9 job openings per unemployed person. And so there's also came in a drop in quits. So there's came in at 4.1 versus 4.2 previous. Not too significant, right? This is also still very high with historical standards. So we kind of interpret this job openings report. You can see where the job openings kind of increase. So we look closely in construction.
You're like, hashtag. Sorry.
Keep this. Pretty good. So construction increased from 386,000 to 422,000 for the month over month. We see that we have a little bit of increase in transportation, trade, and utilities, an increase in retail trade, increase in utilities. What else? Some hospitality, So kind of increase in those sectors, will help, the job openings report, right? So we still have a strong labor market. And so it means, that the employees still have a say in their wages, right? So it leads to this tight labor market, and it could be adding fear of this wage price spiral. So wage price spiral is like where the wages increase, so the prices increase, which leads to inflation increasing, right? So when people have more wages, they spend more money, which increases inflation. So this quits have topped 4 million for 15 months. So it just means it's easier to get a job. I'm gonna dive deep into that in a few slides as well. So there's a rise in productivity. It came in at 0.3%. You can see the previous 2 quarters, Q1 fell at for 6.4%, and Q2 productivity fell at 4.1%. So looking at this in such a short amount of time, it's not, it doesn't really provide much value. Productivity is better measured in a long-term point of view, right? So it's also a very cyclical measurement, right? So it increases when the economy is doing great, and then it decreases when the economy does bad. But all economists believe that productivity is probably one of the most important indicators or metrics in the economy, but it's also one of the least understood, right? So I was researching this, and there's really not a lot of information on productivity because it's one of the least understood. So this is also one of the largest plunge in productivity since the 1940s. And so if we interpret this, right, so lower productivity means that there's going to be less output, right? So people are maybe working less. There's going to be less goods going out in the market. So that means companies are going to have to make up for that, right? So they're going to higher prices. So the higher prices, that decreases demand, right? So which decreases GDP, and then there's going to be lower wage growth, right? Because companies aren't making as much money, right? And so if you have a higher productivity, it leads to lower prices because now there's more output, more supply in the market. Leads to higher GDP growth and then higher wage growth. The non-farm payrolls became a job creations, they slowed. As you can see in this chart, the job creations kind of higher each month coming in, and it just kept going down. We're at the lowest point for the year. So came in at 261,000 versus 315 previous, and expected was 205,000. So we did beat expected. So we still showing that the labor market is still strong, but there is some cooling going on. So if you see like Lyft and Stripe are cutting jobs, 13 and 14% respectively. And Twitter's to lay off 50%, as we know. Gap is going to cut 5%. Snap is cutting 20%. Robinhood is cutting 23%. Shopify 10%. And then Amazon is going to freeze corporate hiring. And then retailers are expecting to hire fewer holiday workers, right? So it's either because they have overhired, right? So they overhired, they're not going to hire too many workers because they already have enough workers, or it's because they expect that there's not going to be a lot of demand during holiday, right? So if there's not a lot of demand during the holiday, that means that earnings season for Q4 is not going to be that good, right? So unemployment rate came in at 3.7% versus 3.5% previous. So we see a rise, right? But also the month before that, it was at 3%. Then last month it came in at 3.5. So it's still kind of in line. It's still at historical lows. But if you see the next month coming at a little bit higher, and that means okay, there is some cooling in the market. People are actually getting laying off. Employees don't have the power of moving around companies, as you see. So the total employed rose by 306,000 to 6.1 million. So there's currently 6.1 million people unemployed. So here I also have the labor force participation rate. Came in at 62.2% versus the 63.4% pre-pandemic. So this kind of measures the people actively looking for work and the people in the labor force over the working age population, which is from 16 to 65. And so this kind of just shows that there's not a lot of people, or there's more people out not looking for work now than there was previously before the pandemic. And also kind of helps to reiterate the quits, right? So there's a lot of quits. So that means that there's a lot of people like jumping in and out of jobs. So they think they can go to a better job that's paying more, or they're quitting, or they're getting laid off, and they're just not going back and looking for jobs, right? So they're just coming out of the labor force and not actively looking for jobs, which is leading to this kind of decrease in the labor force participation rate. So the diesel storage. So there's recently an article that came out, right? The Energy Information Administration said that we only have 25 days worth of diesel supply left. So it doesn't mean that there's just 25 days left. There is still refineries like pumping the oil, so there's always going to be supply, but it's just that there's more demand than supply is coming onto the market, right? So usually, I think the average is we have 35 to 40 days of diesel supply at one time. So if they were to stop pumping, we would have 35 days worth of it. But right now we have 25 days worth of it. So that's kind of, it poses some kind of risk, right? We see this diesel prices are at basically all-time highs since the 2000s. They're at $5.82. So that's kind of high, right? So what causes, of course, the Russian invasion caused this, right? Well, that's one of the reasons. And then also the refinery capacity in the U.S. has dropped since COVID, right? So a lot of capacity is closed down, and they did not reopen them back up. And so this kind of, what happens when there's a diesel shortage, it kind of really affects everything, right? So the transportation costs get higher, the construction costs get higher, the goods industries get higher, so like groceries are going to get higher for that because construction, you use the excavators require some sort of diesel, right? Transportation, you have the freight cars, the freight trains. They require diesel, so there's also the tractor trailers require diesel, and the tractor trailers transport all these goods, and so the grocery store is going to have to pay for that increased cost, and eventually they'll just pass on that increased cost to consumers, which just leads to higher prices, right? So yeah, that's it for me, guys. You guys want to add me on LinkedIn?
Thank you, Alex. All right, so this week we actually have two topics. I was going to cover one, and then we had a emergency topic happen as well in the last day and a half. So to start with, we have Binance and FTX. Your two CEOs there, Sam Bankman-Fried for FTX on the right, and hold up. We're just going to call him Zhao on the left. That's his last name. Two young guys, Sam Bankman-Fried's 30-year-old, $15 billion man, invented FTX. They're both crypto coin exchanges. And so FTX is having some issues. Actually, Binance owned a bunch of FTX's coins, their stable coin, and they said, we're going to unload these. And FTX said, we'll buy them. And then FTX had essentially a liquidity issue. And so Binance said, okay, we'll buy you, FTX. We'll acquire you. And there was this big issue of like, was Binance just outright trying to kill FTX? And so the deal actually didn't go through, and FTX is struggling and not sure how it's going to pay. It's having a liquidity issue as well. And so you have Sam Bankman-Fried, who's lost 94% of his net worth in a single day. He was a $15 billion man, and now he's no longer a $1 billion man. And Bitcoin fell from around 20, I think that's 22K this week to 16 and 335. That's partially going to be from the election, I would assume, and then also partially from the whole FTX having a meltdown situation. Ethereum looks about the same. And then FTX's actual token that they were talking about, essentially it was at 25 a week ago. It's at $2.73 now because after it found out that FTX didn't have the liquidity to pay for all the tokens. There was a run on the FTX token, big crash. People lost a lot of money. Another issue with the FTX thing is FTX kind of propping up the crypto market because they had a couple other coin exchanges that had gone under a couple months ago, like Voyager Digital, and FTX kind of came in and said, we're gonna help you out and try and save you. So if FTX goes down, obviously it's not good for the whole crypto market. And so that's partially why Binance is saying, like, why would we kill FTX? If we killed FTX, that's terrible for us, and we might not do well either. So that's for the emergency M&A presentation. And then the one I actually wanted, or I was planning on doing, was Vital Pharmaceuticals, or VPX Sports. It's a sports energy drink company started in 1993 by a Florida man named Jack Owak. He was a high school science teacher. Supposedly, he says he was. He might have been a substitute teacher. There's not much information on this. Anyway, they had this drink before 2012 called Redline. It was the energy drink with the most caffeine ever at the time. It sent 4 people to the hospital, some teenagers. But that's not the story of this M&A presentation. Their big product came out in 2012. Sure, a lot of people have heard of it. It's Bang Energy Drinks. Your CEO there, Jack Owak, another billionaire. So they had your case sales for Bang Energy Drinks from 2015 to 2021. You can see in 2019 they had a giant, just explosive growth, basically 4x. And then so far this year, according to Statista, as of May, they were still the number 3 energy drink in the US, followed by Rockstar and Reign. Reign is owned by Monster Energy. So how did Bang become the 3rd most popular US energy drink? There's 2 reasons. First of which, so here is your caffeine amounts, and you can see Bang is in the top row, 3rd, and it has 300 milligrams of caffeine. Now there's another one in there called Reign that has 300 milligrams, but they came out after Bang. So Bang was actually the first one. And so it's like, we have the most caffeine, makes sense of why people would want to buy it. It's almost twice Monster, 3x a Red Bull. And there's no sugar and carbs. And so they also, number 2 of the physical reasons is super creatine. Apparently, in their drink, they have creatine, but they have the special super creatine that's 20x regular creatine, supposedly. And so the 2 big selling points for health reasons was no sugar, no carbs, but the max recommended caffeine intake amount is 400 milligrams, which this is 75% of that. So don't drink 2 if you're going to buy any.
Definitely done this.
Number 2 reason was the marketing strategy. There's 2 main parts to the marketing strategy. There's the good version. They hired a bunch of TikTok creators. They hired hundreds of them and just told them to put their drinks in your video. Just make a normal video like normal, whatever TikTok you want to make, but have it in the background, have it somewhere. And also Triple Wallace comedian also came out with a very popular video of drinks in Bang Energy once. Very funny, has about 6.5 million views in 2019. This is all when they're exploding. There's another guy on TikTok. And so there was another marketing strategy, and it's the bad one, the ugly one. So the following quotes are from founder, CEO, and chief scientific officer, 60-plus-year-old Jack Owak. If you ain't banging, you ain't hanging. Our competitors are selling life-sucking soda. And then Bang provides body and brain fuel that will reverse mental retardation. And other forms of dementia. So, this is when things don't go as well. for them. So Bang was having this deal with PepsiCo where they were doing distribution for about 8 months. But then the CEO kind of said they're ripping us off. And so they cut from the deal, and they are doing direct to distribution now. This happened in June. And then following up, there was talks that Keurig Dr. Pepper was going to buy Bang energy drinks. The next day, Keurig Dr. Pepper very explicitly said, this is not true, and we are not buying Bang energy drinks. We don't want anything to do with them. And then Monster Energy Drink won a $175 million trademark. It's actually, they kind of kept it. Bang was trying to get this taken off, but the court ruled in their favor. Essentially, there's a different company that Monster owns called Orange Bang. And so there was a trademark thing and you couldn't put a certain name on their drink. Well, they did Bang XFO, I think, and that made it where this had to get put back in place. And then following that, there was another lawsuit from Monster Energy Drink where they got $293 million from Bang. This is from mostly about their claims that it doesn't, or it gets rid of mental retardation and you know, the rest. Also the claims that Monster Energy Drink was a soul-sucking soda that didn't go very well. And also it came out the fact that they don't have any creatine at all in their super creatine drink. And so that didn't help either. And so that's all incorporated in that $293 million price tag. So Bang went bankrupt. They filed for Chapter 11 bankruptcy. So Chapter 11 is actually not the very bad kind of bankruptcy. It's a restructuring. So they have to, it's shielding them from the amount of loan or the capital they need to pay. So they owe about $300 million. And so they're trying to get loans to pay for this. They currently got a $34 million loan to try and help them out, and they're trying to get more. But they're still in bankruptcy. But this is not all. They also have some pending lawsuits. Universal Music Group.
What?
Warner Bros. Music Group and Sony Music. For all their TikTok videos they keep making, because they hired people out, but they also made their own. They use unlicensed music. So all three of them are coming after them for probably whatever's left. I don't know if Bang's going to survive this, but for right now, you'll continue to see Bangs until you don't. Yeah, thanks. Everybody sign in.
Ready? I got it. All right. First of all, just real quick on the Costa Rica trip, we're still collecting toothpaste, toothbrush. I asked my church, and last time I asked them, they give me way too much. So hopefully we'll get way too much because I can take it down. I've got an attic, and I think toothpaste lasts a long time. But we have a really good connection with Costa Rica. We built it over 10 years now, so we want to keep that legacy going. So when the team goes down, I've already purchased some Costa Rican flags. Last time I did that, they loved it. They actually built flagpoles and they're in front of the restaurant and in front of the soccer field, but they look horrible. They're as ragged as they can be. So they're just a string. So I bought 2 for each of them. So that's going to be a UTSA gift. And then I talked to the people down there and I was trying to figure out what they would need. And there's no electricity in a lot of places they go. So I want to get them, we're going to do a fundraiser, right? I want to get them a portable solar, but I know nothing about this. So if any of y'all have expertise or you have a dad that knows all this stuff or a mom that this is what they're in the garage constantly doing this kind of stuff, is there a big difference between a $1,600 one and a $140 one. I have no clue. Home Depot has these and they're right around the corner. I can go there and have them rip me off. But if someone wants to help me not get so ripped off, volunteer and help me out. Anybody have an expertise here? Any solar panel? Oh, yeah, we got her. Okay. So maybe we could do a trip to each Home Depot. All right. So I want to talk about value stocks versus growth stocks. So a growth stock is an expensive stock. It's high quality. It's making a lot of money. But most of the value in the stock is way out into the future. A value stock is inexpensive stock, has something bad's happening. Maybe they have a lot of debt. Maybe it's a dying industry. It's a cheap stock. The traditional view is growth stocks hate high interest rates because so much of their value is way out into the future. So when rates rise, they tend to sell off. Value stocks, because they're weaker companies, they hate recessions. So we're in this really weird year where interest rates are going up and we're talking about recession. So it's like avoid growth stocks and then also make sure you avoid value stocks. Well, my curiosity was, we know growth stocks have sold off, but how much have they sold off? So one thing I wanted to do was graph the S&P 500. This is the S&P 500. The blue is the S&P 500 without those heavy growth stocks that we've seen. The Apple, Microsoft, Amazon, Google, Netflix, Tesla, Meta, and NVIDIA. And you can see those stocks got massive, especially after COVID. And then they also sold off a lot more. Here they are, the percentage of the S&P 500. Isn't that amazing? They were 40% of the S&P 500 at one point. Just ridiculous. In fact, I should look at the numbers. I think may have been larger than the S&P 500 was when them by themselves were larger than S&P when I was running stock portfolios 15 years ago. It's pretty amazing. They've come down a lot, but they're still 27%. They're still over a fourth of S&P 500. What does that mean for returns? For the S&P 500, the last 14 years ending 2021 was up about 8.6%. 2022, that annual return has been clipped a little bit. So it's only up 6.71. That's without dividends. So with dividends, it's a little bit higher. If you take these major growth firms out, the S&P really didn't slip that much. And so if you look at it this year, the S&P is down 22%, but it's only down 15% if you take those stocks out. So we don't really have a bear market this year if you take those companies out. It sounds a lot like 1998, 99. In 98, 99, the stock market shot up, but it was driven by just a few companies. And in 2000, 2001, it dropped a bunch, but actually a lot of like small cap and a lot of firms, you could have bought a lot of stocks in 2000 and not lost money. Anybody know what that's called? Market breadth? Yeah, market breadth. So there wasn't much market breadth in 98, 99, 2000. There's not much market breadth this year. Your few stocks are driving everything. That's actually good news on the way down. It's bad news on the way up because then it's, you're gonna see a crash, but that means you can protect yourself. So what does that mean for value versus growth? So the traditional view is avoid growth if rates are rising, avoid value if you have a recession. So some people are saying, okay, well, rates have already risen, value's already had its run, so get out of value, get back into growth. So they're arguing, this is from GMO, they're arguing, no, that's not true. First of all, they say stocks are going to fall more. If you know GMO, they've been pretty bearish. We have long said that valuations are stretched and that investors should be cautious. When your exposure to beta just means your exposure to the stock market. One of the reasons that we remain excited about the value versus, so they're actually buying value stocks and shorting growth stocks, and they think that trade's still on. I'm actually kind of in that trade myself. Is the fact that is broadly equity beta neutral. What they mean is if you buy value in short growth, you won't be related to stock market. Stock market falls 20%. That trade won't necessarily go up or down. It'd be beta zero. It means it's diversifying. You don't want a strategy that if the market crashes, it's also going to crash. That's not a good strategy to have. Very desirable characteristic. The strategy is long the cheapest value stocks. That sounds really dangerous, doesn't it? What's one of the cheapest value stocks right now? Probably Meta, I guess. Probably Macy's. maybe J.C. Penney, probably Sears is a pretty cheap stock, right? The cheapest value stocks, and short the most expensive. Now, the cheapest doesn't mean Sears probably isn't that cheap because they don't have any earnings. So value is their price versus their earnings. If their earnings are nothing, then there is no value there. So, but Meta would certainly fall in that category. And then short the most expensive growth stocks, they're still the same ones. It's still the Teslas and the Microsofts and those types. A narrative of low rates. So he's challenging what I tell my investment class. Growth stocks hate rising rates, value stocks hate recessions. They're saying longer duration growth stocks means they're sensitive to interest rates, have been a force behind growth stocks hitting bubble levels. However, we do not believe there's an underlying fundamental connection. And historically, they're saying that connection between value versus growth and interest rates really isn't all that strong. Sometimes it's positive, sometimes it's negative. While higher inflation and rates began to unwind the value growth gap. So they're saying, yeah, higher rates did help value stocks come back. They don't think it's all you need. Why? Because I think value remains grounded in fundamentals and really doesn't matter about the path of rates. Rates could fall down and the value stocks are still going to do better. That's their argument. This is a lot of verbiage here, but
Pointer, Leonardo Velasquez.
the market has retained its sights away from interest rates and crosshairs and now is focused on recessions. And so what they're saying is growth has actually started to outperform again, which you would expect in a recession. There is, of course, some logic in this that lower quality and cyclical value stocks will struggle in a recession. We believe that accounting for the quality of the company. So what they're saying, and I've heard this trade as well, this is a trade we tried to do in the investment society and in COVID hits. We should probably set it up again. But is rank all the stocks, value and growth, and then pick the highest quality value stocks. That's what they're saying. So pick value stocks and then grade them on quality, which is really easy to do. And then buy those stocks. So crucially, what both of those arguments are failing to take in consideration is valuation. We believe that value will outperform growth purely and simply because it is priced to do so. So what they're saying is, yeah, value has come back, but it's still way off. This line right here is the normal relationship. Value is still a whole lot cheaper than growth. So value has still a long ways to go. What happened the last time value got really cheap? It didn't go to the line, did it? Way beyond it. And that's essentially what they're saying is value is going to come back. It's going to have its heyday. Finally, we've been waiting so long. So, all right, am I out of time? Boy, what time is it?
Keep it going, sir. Keep it going.
What time? 2 minutes. All right, one last thing. This is an economist article, and they're asking, what should the Fed target for inflation? Their argument was that 2% they keep giving us is like an artificial random number, someone said. There's a lot of those numbers in US politics and economics. Someone said a number at a conference sometime, like retirement age at 65. Someone said it in a conference and suddenly everybody retires at 65. So the Fed said 2%. No one knows why. Someone said 2% and they said, yeah, that sounds like a good number. Now it's like sacrosanct. Well, the economists said, well, is 2% really the right number? And so what they decided to do is say, when does the consumer start obsessing about inflation? Because that's when the Fed should be worried. And so what they did is, when did people start Googling inflation? And they said they start Googling inflation somewhere around 5%. 5% inflation is when we start panicking. 3%, 4%, we're kind of okay. 5%, we start panicking. And he's saying, the Fed could target 3.5%, 4% inflation. Probably our economy would be perfectly fine. There's no reason for them to crash us into this horrible recession just to get back to this artificial 2%. 4 is fine. Most of my life, we loved 4% inflation. We were like waiting my whole high school years, we're waiting for 4% inflation. We were having 10, 11, 12% inflation. So yeah, that was interesting, right? It's an interesting way to look at what the Fed should do based on because if the consumer's not thinking about inflation, it's really not an issue, right? Because why is inflation a problem? You're worried about inflation, what do? You start buying stuff faster because you're worried the price is going to go up. And what does that do? Causes price to go up. You're worried about deflation, what do? You hold off on buying something because the price will come down. What does that do? Causes price to come down. But if you're not thinking about inflation, you're just normal. And that's what that's what this article is arguing. The Fed should worry about when the consumers are worried. When consumers aren't worried, they have a much wider range they can work within. But who knows if they'll listen to the economists or not. All right, and I told y'all this, some of y'all asked for that. I don't know how to get this out to y'all, but again, just back to the resume thing. The one thing we probably should emphasize more is certifications. Get more certifications. Bloomberg Market Concepts, Capital IQ, whatever. Get these things in your resume because they're really powerful in a resume. All right, that's it for me. I'm probably over a little bit.
Thank you very much, Professor Susan.
Yeah.
Continue with today's meeting. Society updates. Okay, so the Market Watch competition, it's still ongoing. It's ending the week of Thanksgiving break, and I'm still ninth place, surprisingly. We got our top three right here for now. Raul Medina's first as of now, Jacob second, and Jackson's number three. The top three winners do get a gift card. So there's pros to that. So another big announcement is that MD positions are available for next semester already. So we're announcing them today, and next week, our next general meeting will just be voting on these positions. So basically, all of them are open except president, and you can submit your slides. So you get to apply and run for the position by sending us your slides and what positions you would want to run for. You could run for more than one, but you can only be one position in the spring semester. And our email's right there. You can send us your application with the slides attached by November 16th, which is the date we will be voting for who gets what position and whatnot. So definitely wouldn't want to miss out next week's meeting. Is there any questions on this? You'll have to present, come up here, max of 3 minutes, just talk about why you want the position, what you'll do, like what would be your impact for the investment society here, and a background on yourself. Is that what you said? Okay. Yes, that. And I put some points there of like why you should be an MD. I think it's been very beneficial. Not only is it a resume builder, but you develop your skills, right? And you create that impact for the society. Any questions on this? I know there's been several interests going around that someone wants to run for an MD position next year. And current MDs are also able to either switch position, rerun for their current position and whatnot. Any questions? Did I forget anything, MDs? I think. If you are interested in like learning full details of like what our MDs do, I will be posting a document on our socials, mostly Discord, showing what they do on a day-to-day basis. Like our treasurer, he has to keep track of our funds, right? And give away these gift cards, which are upcoming. Where's your treasurer? Oh, he's over there. Yeah. So I'll share this information out with y'all later too. And thank you. Let's get ready for the gift cards here. Our weekly gift card giveaway. Let's see. All right, go ahead.
All right, drum roll, please. Your first winner is Larissa Valdez. That's nice. Okay, great. See me after. Drum roll, please, for the last winner. Alejandro Aguirre. Come see me after and you know set up.
Real quick, we are selling t-shirts. Is anybody wearing it right now? Okay, telling me. They're up front, but yes, we're selling t-shirts. So meet us after here. Jason will be keeping track of payment. You can pay through Zelle, PayPal, and he's taking cash as well. Yeah, so thank you everybody for joining. See y'all next week.